Welcome to our webinar on IAS 1, Presentation of Financial Statements, the amended version of the standard. The amendments come about as a result of the Disclosure Initiative, which is a project that the IASB are currently undertaking to try and improve on the disclosures that we're currently providing when we prepare our financial statements. Now, when one looks at the preparation of financial statements and one looks at what IAS 1 has, IAS 1 basically says to us that it applies to all companies that are preparing general purpose financial statements. And by general purpose, it basically means those that are intended to meet the needs of users that are not in a position to require an entity to prepare reports that are tailored to meet their particular information requirements. It also assumes that by preparing your financial statements in terms of IFRS, that will result in fair presentation of those financial statements. Now, in making this assumption, it basically assumes that by disclosing all the information that is required of you by IFRS, that will result in this compliance, first of all, in compliance with IFRS, as well as this fair presentation. Now, what has happened over the years is, as people have been reading through the accounting standards, they basically have read the accounting standards to mean that they're a checklist of what information should be disclosed in the financial statements, whether or not that information is important, whether or not that information is material. Now, the rule of thumb that we need to be applying here, and which we should have been applying over the years, is that IFRS does not apply to things that are not material to begin with. So if it does not apply to things that are not material, there may be certain information that we may not need to put in the financial statements. So what the Disclosure Initiative project aims to do is improve on the presentation and disclosure in the financial statements by clarifying exactly what it is that should make it into a set of financial statements and what should be excluded. So the project in its current form, and there will be additional projects that will be undertaken over the next couple of years, is that this particular project addresses 4 specific areas. The first one being materiality and aggregation, defining what materiality is and what we are permitted to aggregate when we're preparing our financial statements. The second issue is around what we're required to disclose at a minimum in our financial statements. The third is the presentation of other comprehensive income and what we show in the financial statements relating to this. And the fourth is the notes to the financial statements. What, again, at a minimum should we disclose in the financial statements, or does that at a minimum still apply? We will start off by having a look at the definition of materiality. This is a concept that I think we've all become accustomed to over the years, but just to make sure that we're all on the same page, we'll go through it anyhow. Now, the context in which materiality is spoken about in IAS 1 is that the standard says to us, something is deemed to be material if its omission or if its misstatement could individually or collectively influence the economic decisions that users make on the basis of the financial statements. Now, materiality in itself then ultimately depends on the size and the nature of the omission that we're dealing with, or the misstatement that we're dealing with, as it is ascertained, taking into consideration the surrounding circumstances. Sometimes you may find that a small number may be material in itself because of the context in which, because of the nature of that particular amount. And sometimes even a big number may be deemed to be immaterial when taken in the context of the greater circumstances in which it exists. So what we're basically dealing with here is a judgment call on materiality that is based on quality of the number that we're dealing with, the amount that we're dealing with, or quantity of the amount that we're dealing with. Now, to put into context where we're going with all of this, I'm going to ask a few questions, and I'd like you to just jot down in your own mind what your view is of the questions that we're asking. my first question is, if an item is not material enough to be included in the primary statements, do you still need to disclose it in the notes? Take a moment to think about that. Second issue that I'd like to ask you about. If an IFRS requires you to disclose a specific item, do you need to make all the disclosures in the standard relating to that particular item? Again, I'll give you a moment to think about this. Third issue, where an IFRS standard gives a list of required disclosures, all these items must be disclosed. True or false? Now that we've given this some thought, let us have a look at what IAS 1 says about the process of preparing our financial statements. And it says to us that an entity shall present separately each material class of similar items. An entity shall also present separately items of a dissimilar nature or function unless those items are immaterial. So the long and the short of all of this is that we should aggregate information into classes according to their nature or function and taking into consideration their materiality. And this also takes into consideration the fact that the numbers that we're preparing, the financial statements that we're preparing, are an aggregation of a whole bunch of numbers or a whole bunch of different transactions that we'll need to put into different buckets depending on their nature or their function. At the same time, IAS 1 also says to us, and this has always been there, that if a line item is not individually material, then it must be aggregated together with other items. So taking all of this into consideration, how then would you answer the questions that I asked you earlier on? Now if you go on to the amendment that has been made to IAS 1, it now states that an entity shall not obscure material information with immaterial information or by aggregating material items that have different natures or different functions. So obviously in the process of then deciding what you will aggregate and what you will disaggregate, that must be based on the circumstances that exist, the relevant facts that you've got around the items that you're dealing with, and obviously there's going to be some judgment that's involved in the whole process of then deciding what should be aggregated and what should not. In addition to all of this, IAS 1 has now also been amended to state that where an IFRS requires an item to be included in the financial statements, the disclosures relating to that item need only be given if they are material. So basically, going back to what I said earlier on, is that IFRS focuses on materiality, and if something is not material, then basically there's no need for it to be disclosed in the financial statements as such. It can then be aggregated together with other things of a similar nature. They might be dissimilar, but may then be aggregated with other items and then disclosed in that particular fashion. This also applies in situations where the standard might describe the particular disclosure as a minimum disclosure requirement. Then the standard is now clarifying that minimum requirements do not apply if that particular item is not a material number. What the standard also goes on to say is that the organization that is reporting should also consider, to the extent that it is necessary, whether or not it should provide additional disclosures in order to enable the users of the financial statements to have a better understanding of the transactions that have been undertaken and to assess the impact of those particular transactions on the organization's financial position and its financial performance. So as much as we've now been given some leeway to reducing the amount of disclosure in the set of financial statements, the standard setters are also asking us to see whether or not there's additional information that may be required in order to make those financial statements more understandable. What we used to have in the financial statements, specifically on the statement of financial position, is that IAS 1 required us to show at a minimum certain line items, and it gave us an entire list. Property, plant and equipment, investment properties, inventories, the list that you can see in front of you. All these items were included on there. Now the question that then arises is, say for instance my provisions number happens to be an immaterial amount. Does the fact that I am required to show at a minimum the provisions number then mean that I need to show that number as a separate line item in my statement of financial position? And again, going back to the amendment that we've got to IAS 1, my trade and other payables and provisions numbers could all be aggregated into one line item. There will be no need for me to separate my trade and other payables and from my provisions. So what IAS 1 has done in the amendment is that where it listed in the number of items that were required as at a minimum items in the statement of financial position, these items have now been this requirement to disclose these items at a minimum has now been removed. The IASB have also clarified that these items may be aggregated if they're material. Now the stress point here being on may be, because that then tells us that we've got that choice based on our assessment of materiality to then decide how we're going to show this information in our financial statements. And this takes us to the second of the amendments, which is the minimum line items that we show in our financial statements. Again, I have a question for you. Does the same apply? And the same meaning minimum disclosure requirements. Does the same apply to the statement of profit or loss and other comprehensive income? On the statement of profit or loss and other comprehensive income, while the standard doesn't actually use the words at a minimum, it does require that we show certain information in the financial statements, such as your revenue, your finance costs, share of profits and losses from associates and joint ventures where you use the equity accounting method, the tax expense, the discontinued operations number, and so forth. What the IASB have done in making this amendment is they've suggested that the subtotals that are used be comprised of line items that are made up of amounts that are recognized and measured in accordance with IFRS. At the same time, they've also asked that the disclosure that is done, that the line items that are provided be presented and labeled in a manner that enables the reader to understand what constitutes that particular subtotal. So basically the number should be clear and understandable. And there must be consistency in the manner in which the number is determined from period to period. The IASB have also gone a step further, and they've said that whatever subtotals are provided in the statement of profit or loss and other comprehensive income, they must not be displayed with more prominence than other subtotals and totals that are required by IFRS. So taking all of this into consideration, hopefully now we have a easier way, or more understandable way, of deciphering what is required in a set of financial statements and how that information should be presented. Another issue that has been dealt with as part of this amendment is what items make up other comprehensive income. I'll give you a moment to jot all of this down. To jot down from your perspective what items make up other comprehensive income. I wonder how many items you've got on your list of items that make up other comprehensive income. See how many of you would have at least as many as I do. I don't necessarily want you to tell me which standard it comes from, that would be nice, and whether or not that item will be recycled and when it will be recycled. But what you should have had were lists that are similar to what I've got here, ranging from foreign currency translation reserves through to gains and losses arising on available for sale financial instruments, cash flow hedges, revaluations of property, plant and equipment and intangible assets, remeasurements on defined benefit plans, movements arising on financial instruments out of IFRS 9. So we've got a fair list in front of us. Now going back to what IAS 1 says about items of other comprehensive income and how we deal with gains and losses that are recognized through the statement of profit or loss and other comprehensive income. It is very categoric in that all items of gains and loss nature are recorded in the profit or loss section of the statement of profit or loss and other comprehensive income, with some exceptions. And those exceptions are these items that you can see in front of you. Now, how we then present our statement of profit or loss and other comprehensive income is it would show all the gains and losses in profit or loss except for those 9 items that I showed you on the previous slide. And in showing those items, we then have to split them between the items that will be reclassified at some point and those items that will not be reclassified. And you'll see on the previous slide, the items that will not be reclassified are basically the items that are arising out of IFRS 9, the revaluations, and the defined benefit scheme movements. Everything else will be reclassified at some point. So in the other comprehensive income section of the statement of profit or loss and other comprehensive income, we're required, based on the previous amendment to IAS 1, to split our items of other comprehensive income into 2 categories. Those that will be reclassified at some point in the future, and those that will not be reclassified. Herein lies an issue. Because when one has a look at the items of other comprehensive income that arise out of joint ventures and associate companies in which we apply the equity accounting method, we're basically required from equity accounting to recognize our share of profit or loss of the equity of the associate companies or the joint ventures profit or loss. We're also required to recognize our share of their items of other comprehensive income, split into those items that will not be recycled and those that will be recycled at some point in the future. Now going back to the slide that I showed you earlier on, in preparing my financial statements then, I'll then be required to show in the profit or loss section all the gains and losses except for those items that go through other comprehensive income. In the other comprehensive income section, I'll be required to show my items of other comprehensive income that will be reclassified and those items that will not be reclassified. So the amendment clarifies that the same way that we treat other items of other comprehensive income that relate to our normal business, we need to treat those that result from our equity accounted investments in exactly the same manner, splitting the items of other comprehensive income into what will be reclassified and what will not be reclassified at some point in the future. Another issue that has also been dealt with as part of this change is the whole process of drafting the financial statements and how we order the notes that we have in our financial statements. Now my question to you is simply, how should you order the notes to the financial statements? Is there a particular format that we need to follow? Is there a particular order that needs to be adhered to? There is a perception out there that there is an order. So what the ISB have done as part of this amendment is they've clarified that the notes should be arranged taking into consideration the understandability and the comparability of the financial statements. So I think as much as we might have grown accustomed to structuring our financial statements in a particular fashion, the challenge that we're putting out there based on this amendment is there a way that we can better order our financial statements to enable people to understand information that is being provided to them a little easier. So we're facilitating the reading of the financial statements, while at the same time not losing the ability of the user of the financial statements to compare with what has been done in the previous years. Examples are provided on how the notes could be structured going forward, and they range from giving prominence to areas that the organization considers to be the most relevant, to the user obtaining an understanding of how the organization has performed during that particular financial period and how it's arrived at the financial position that it's in. And this basically means grouping information together around particular operating activities in a manner that enables, that does not require the reader to scoot between page 14 and page 28 before they can get a sense as to what is sitting in the financial statements and what those financial statements are reflecting. Another matter has been around grouping items that are measured on a similar basis. For instance, where we might have items that are carried at fair value, whether it be financial instruments, whether it be putting all the financial instruments together in one area of the financial statements, and dealing with the fair value disclosures in that same section. Then again, that way people aren't scooting between different bits of the financial statements before they can get to a proper understanding of what's going on with that particular item. Another manner that we could approach this is following the order of the primary statements. And I think you'll find that a lot of companies have been doing this in the past. Something else that we could possibly do would be, who said that the accounting policies must always follow the primary statements? Could those be put somewhere else in the financial statements? Are there things that are sitting in the accounting policy that may not necessarily be relevant at this point in time that could be put later on in the set of financial statements? So all of these things, I think, are things that we can work with, that we have some leeway in terms of how we structure the financial statements. We've come across companies where they've gone and they split up the accounting policy, so they don't have a particular section on accounting policies. So what they'll then do is that if Note 1 deals with property, plant and equipment, for instance, the beginning section of Note 1 will have the accounting policy on property, plant and equipment, and it'll then be followed by the notes, by the detail of the movement that we've had in property, plant and equipment during that year, and how the property, plant and equipment balance is actually made up. Then that way the reader is basically dealing with everything related to property, plant and equipment in one section of the financial statements, obviously with a cross-reference back to the primary statements, the statement of financial position. So how you approach this, that'll all be up to you, but ultimately, as a preparer of financial statements, the role that you're playing is facilitating the reading of these financial statements by the user of those financial statements. Another question that we should ask is, what is the most relevant disclosure for your particular company if you're the preparer of the financial statements, or for your client if you're assisting somebody else in preparing their financial statements? Now, in this particular matter, I'm now addressing the disclosures that are required of you in your accounting policies and in the notes that support it. Going back to IAS 1's requirements, when it comes to our accounting policies, the standard requires us to disclose notes comprising a summary of the significant accounting policies and other explanatory information that elaborates on what we do as an organization. Now, what they've done in the amendment to the standard is they've taken out the words "a summary of," and it simply now reads "notes comprising significant accounting policies and other explanatory information." At the same time, they've added in there that each organization should consider the nature of its operations and the policies that the users of its financial statements would expect to be disclosed for that type of entity. Now, there's two issues that arise out of this. I'll deal with the first one, that of the wording around the accounting policies and the other explanatory information that is provided. Various regulators around the world have been doing proactive monitoring of financial statements in order to try and make sure of the compliance with IFRS by various reporting companies. And when you look through the reports that they've issued, a lot of the commentary has been around the boilerplate nature of the accounting policies that have been applied. Companies that basically take word for word what the standards require of the organization and use that as the accounting policy. So in some instances you find that companies will talk about the company shall do this and the company shall do that. Well, is the company doing it or not? Let's talk about the reality of what's actually happening. So if the company is doing something, well, let's talk about what the company is doing. Secondly, you'll find that some organizations put in place accounting policies that do not necessarily talk to transactions that impact them specifically. So a company that has simply got debtors and creditors on its balance sheet, statement of financial position, but it refers to, when you look at the accounting policies refer to trade date accounting, settlement date accounting, things that may not be relevant, or it refers to hedging arrangements that don't exist in the context of that particular organization. While we understand that some accounting standards may be complicated, what we're trying to demonstrate in preparing our financial statements is addressing the significant accounting issues that the organization is faced with. Now, if something is not significant from your point of view as an organization, then the accounting policy should not reflect it. Again, going back to the principle that we spoke about earlier, that IFRS should address the issues that are significant in the context of the organization. So ultimately, in deleting a summary of significant accounting policies and only leaving in comprising significant accounting policies in the wording of IAS 1, what the IASB is hoping to achieve here is that we would now go back and have a look at the wording of our accounting policies, and with the view of only including in there the things that are significant to what we're doing, the things that are material to what the reporting entity is working on. If I go to the second of the two bullets that you can see in front of you, each entity considers the nature of its operations and the policies that the users of its financial statements would expect to be disclosed for that type of entity. In a way, I've sort of addressed this, but just to put a cap on it, is that what we're saying here is that when an organization looks at its accounting policies, they must be relevant to what it's doing. At the same time, what we disclose in there are things that are material. At the same time, an organization, when it's preparing its financial statements, should also benchmark itself against other organizations in its industry, just to make sure that they're in the right path. Because you obviously would not want a situation where you go and start addressing matters that other people within your industry may deem not to be significant, or you're completely out of kilter with everybody else, such that the comparability between organizations is compromised. But as much as I say that, we must also take into consideration the fact that if something is not material, then it shouldn't make it into the financial statements. But if something is keeping you awake at night, it must mean that it's material from your point of view, and therefore it must then be addressed in the preparation of your financial statements. For those of you who have the time, who've got the inclination, have a look at the reports that have been issued around the world by various regulators. The European Securities and Markets Authority have got a report that they issue on an annual basis. The JSE, the Johannesburg Stock Exchange, also have a report that they issue on a regular basis. Have a look to see the information that they've got on there, especially as it relates to the presentation of financial statements and the boilerplate, the nature of the boilerplate accounting policies that a significant number of companies that are reporting around the world have been disclosing in their financial statements, and their concern with these boilerplate accounting policies. While the standard puts an effective date for all these changes at 1 January 2016, all periods beginning on or after 1 January 2016, with early adoption permissible, the reality of the situation is that these changes are in effect a clarification of what has always been there in IAS 1. If anything, we should already be taking into consideration the requirements that are sitting in this clarification in the preparation of our financial statements long before we get to 2016. Folks, that's it for this webinar on IAS 1 presentation of financial statements. Thank you very much.